684%. Well, let that number just sink in for a second. That is exactly how much Nebius Group's revenue grew year over year in the first quarter of 2026. Now, if you're allocating capital anywhere in the AI space right now, a number like that absolutely demands your immediate attention. So today, we are unpacking the investment thesis behind this explosive metric to see what's actually driving it.
Welcome to This Explainer. I am super excited to guide you through this deep dive. We're going to analyze Nebius's Q1 2026 earnings call, right alongside their 2025 SEC filings. Our main goal here? To give you a completely clear, impartial look at the fundamental drivers, the massive mega contracts, and, of course, the very real capital risks, all strictly from an investor's perspective.
So here is exactly how we'll break it down today. We'll start off with those explosive Q1 financials, map out their 4 dimensions of growth, examine their massive big tech partnerships, look at how they're financing this wild CapEx boom, and finally, we'll evaluate the key risks that every smart investor needs to know.
All right, let's jump right in with Section 1, Explosive Q1 Financial Results.
Beyond that staggering 684% revenue growth, you really need to look at the incredible operating leverage at play here. Nebius saw its AI cloud adjusted EBITDA margin nearly double, literally jumping from 24% in Q4 to a massive 45% in Q1. According to their CFO, this impressive leap is being driven by rapid capacity scaling and some really strong pricing power, basically because market demand is just drastically outstripping supply right now. And that surge in demand, it brought their total group revenue to $399 million for the quarter, which pushes their annualized run rate for the AI business to an incredible $1.9 billion. And for those of you out there heavily analyzing working capital, here is an absolute golden nugget. They are seeing record upfront prepayments. Customers of all sizes are practically scrambling to hand over cash right now just to lock in their future compute capacity.
Okay, moving right along to Section 2, Nebius's 4 growth dimensions. Let's look at how management is actually orchestrating all this scale.
The CEO laid out a highly strategic 4-part playbook to manage this hypergrowth. They break their execution down into expanding capacity, building out a full-stack product, capturing broad market demand, and obviously securing the massive capital required to keep the whole engine running.
Now, zooming in on that product pillar, you've got to understand that Nebius isn't just renting out bare metal servers. Far from it. They are aggressively building a vertically integrated AI cloud. Through some really smart recent acquisitions like Tavaly, AN, and Clarify, they're bringing industry-leading inference and agentic search capabilities entirely in-house to power their managed token factory service. And on the hardware side, they're one of a very elite group to snag Nvidia's exemplar cloud status on the new GB300 chips. By owning the entire stack from the silicon up to the software, they are actively protecting their future profit margins.
But to feed a vertically integrated product like that, you need power, and I mean a lot of it. Their timeline is incredibly aggressive. They've got major capacity additions coming online in Q3 of 2026 to unlock immediate growth. Looking just a bit further out, they're already prepping for early 2027 deliverables for Meta. Plus, they recently announced a brand new totally owned site in Pennsylvania that's targeted to scale up to a mind-blowing 1.2 gigawatts of power by 2030.
Of course, building gigawatts of data center power is only a sound investment if the demand is actually contracted. So that brings us perfectly to Section 3, Massive Big Tech Partnerships.
When you actually dig into their SEC filings, the numbers are truly staggering. Nebius has successfully locked in these multi-billion-dollar 5-year mega contracts with both Microsoft and Meta. The Microsoft deal over in New Jersey is estimated at up to $17.4 billion. Meanwhile, their recent Meta agreement is valued at roughly $27 billion. You put those together and you're looking at over $44 billion in potential contracted value just sitting right there on their books.
But the real kicker here is exactly how that Meta deal is structured. It is not just your standard capacity purchase. Sure, $12 billion is for dedicated compute, but the remaining $15 billion acts as a guaranteed backstop. Essentially, Nebius has the total discretion to sell this extra capacity to their own AI cloud customers, likely at much higher market margins. But if they somehow can't sell it, Meta is legally obligated to swoop in and purchase that unsold capacity. From a pure risk management perspective, that creates an absolutely incredible revenue floor for investors.
Naturally, servicing tens of billions in compute contracts requires an astonishing amount of upfront cash. So, let's dive into Section 4, Financing the CapEx Boom.
Driven by this urgent need to build out infrastructure ahead of all that 2027 demand, management just drastically raised their 2026 capital expenditure guidance. They are now projecting a massive $20 to $25 billion in CapEx for the year alone. Make no mistake, this is the sheer, uncompromising cost of competing at the hyperscaler level in today's AI era. So how on earth do you fund a $25 billion gap? Well, Nvidia has been highly active in the capital markets. In Q1 alone, they raised over $6 billion, which, crucially, includes a strategic $2 billion equity investment directly from Nvidia. Moving forward, the CFO explicitly stated they plan to leverage those massive Meta and Microsoft contracts to unlock asset-backed debt financing at really attractive rates. And that's going to beautifully supplement those record customer prepayments we talked about earlier.
But listen, every sophisticated investor knows that growth at this blistering scale is never free of risk. Let's pivot to Section 5, Key Risks for Investors, straight from their Form 20F.
So while those mega deals provide incredible multi-year revenue visibility, they also create a really complex picture of severe concentration risk. The SEC filings actually reveal that a single unnamed customer, labeled simply as Customer A, accounted for a full 25% of all Nebius Group revenue back in 2025. You don't have to be a Wall Street analyst to know that if relations sour or if demand shifts away from these few key players, the financial impact to Nebius would be immediate and severe. Furthermore, despite that jaw-dropping revenue growth, the Form 20F explicitly states that their core business is intensely capital-heavy and currently not profitable on a net basis. The filing straight up warns that their ability to operate depends entirely on continuous access to public or private financing. Basically, if macroeconomic conditions tighten up and the capital tap is suddenly turned off, their entire growth engine could stall out overnight.
The company is also taking on a ton of leverage. They warn investors that piling on multiple layers of secured and unsecured debt, specifically to fund these massive data centers, creates a highly complex capital structure. Ultimately, this could really restrict their strategic flexibility. It limits their ability to make agile acquisitions, and it makes it incredibly difficult to weather any sudden, unexpected shifts in AI hardware technology.
So, we've seen the 684% growth, the $44 billion in big tech contracts, and the heavy debt burdens laid out in the SEC filings. As you analyze this for your own portfolio, you really have to ask yourself one critical question. Is Nebius building the ultimate unassailable pick-and-shovel moat for the global AI boom, or are they walking a precarious $25 billion CapEx tightrope without a net? I'd love to hear where you stand on this, and I will see you in the next explainer.